Hello everyone, welcome to Master Stage. And today we'll discuss financial derivatives. Okay, it is part of your fourth sem MBA examination. We'll discuss entire 5 units. Just listen this class 10 times. You're able to attempt your exams easily with content. Okay, so let us have discuss derivatives, introduction and basic concept. Okay, so what is derivative? It is a financial contract whose value is derived from underlying asset. The asset itself is not traded, only the contract. So what is underlying asset includes like shares, stock indices like Nifty 50, Sensex, etc. and commodities, gold, crude oil, wheat, etc. Then currencies, USD, US dollars, European dollars, and interest rates. So these are the underlying assets. I'll read one example here. Uh, for example, an importer needs $1. Okay, dollar 1 lakh after 3 months. He fears that in the future the rupee will weaken. So he entered into a derivative contract today to fix the US dollar or Indian rupees to protect himself from the future loss. For example, a derivative has no independent value. Its value depends on entirely underlying assets. So what is underlying asset? Underlying asset is shares, stocks, indices. Okay, maybe commodities, gold, crude oil, wheat, currencies, US dollar, European dollar, interest rate. These are the, see, one financial contract is depend on underlying asset. Underlying asset means these are the shares, stocks, indices, commodities like gold, crude oil, wheat, currencies, etc. Okay, so this is the thing about how this evaluation and importance of this functioning of derivatives. Okay, let me read brief evaluation. Derivatives began with the commodity risk management. So farmers fixing crop prices and grew into modern financial market covering currencies, interest rates, and indices. So, what is the key functions of these derivatives? Risk management. So, protect against price changes. Hedging. So, in order to reduce the losses from the adverse moves. Then, price discoveries. Reveal future expected prices. Arbitrage. Profit from price difference. Market efficiency. Better information flow. Portfolio management. Adjusting risk exposure. Okay, so these are the derivatives. Like in the future, the prices may go up or down. So in order to protect these derivatives comes into picture, there is a risk management. Hedging means in the future, the market may go up or down. Okay, that time in order to reduce the risk, we uses hedging. Price discovery means in the future, whatever the prices is going to be happen, that is expected price. That is called price discovery. Arbitrage. Okay, so prices differs. Okay, from place to place or from time to time. In the difference, people earn the money. That is called arbitrage. Market efficiency. Okay, if you know the information about the market, you do well. There is a market efficiency. Portfolio management. We already discussed in the previous thing. Instead of putting all the investment in one basket, you are going to allot your investment like stocks, like gold, commodities, real estate, etc. Okay, so this is the, like, initially that finance derivatives was used in the farming sector. Okay, wheat prices may go up or down. So in order to protect that, they decided, uh, like, priorly only. After 3 months, what happened? Nobody knows. That is the reason the farmer used to make the expected price and he will be protected. This started with the commodities. Okay, that is farming, like, thing. Then it is sent into the financial market, the same thing. Then ET derivative. Then risk management. Okay, okay, this is the thing. Then types of derivatives. This is the important question for your examination purpose. There are four types of derivatives: forward contract, future contract, options, swaps. Okay, forward contract means private agreement to buy or sell at a future date at a fixed prices. Okay, example, importer fix US dollar or Indian rupee rate today. So whatever happen in the future, the price will be fixed. The price will be the price will be agreed privately to buy or a sell at a future date at a fixed price. For example, importer fixes US dollar or Indian rupee rate today. Then future contract. So it is a standardized forward contract, traded on a exchange. Okay, those who are dealing with the share market. Okay, so Nifty 50 futures on NSE. So future contract, it is related to the stock market. It is a standardized forward contract. Okay, that is future contract. Options, rights, not obligation to buy or sell at a fixed price. Okay, so this is the thing. Example, call option on share, Reliance share. Swaps. What is swap? Exchange of cash flow between two parties over a time. Two parties exchange the money or cash between them. Okay, so that is called as swaps. Example, fixed rate loan swap for floating rate. Okay, so what you have to remember here, financial derivatives, okay, which is based on shares, currencies, rates. Then commodity derivatives based on gold, oil, copper, silver, wheat, etc. These are the commodity uh, derivatives. These are the financial derivatives. Remember, okay. Then who is the players in the derivative markets? Okay, these are the players. Okay, hedger, speculator, arbitrator, market maker, institutional investor. Okay, these are the players. So what is the main objective? What is the risk of approach? What is a simple example? Okay, hedger. So he reduces the risk, avoids the risk. So farmers fix wheat price. Okay, this is the hedger. Okay, then speculator. So they make the profit from the price movement. So speculator takes the risk, whereas hedger won't take the risk. A trader better on Nifty rises. Okay, traders betting on Nifty prices. Then arbitrator. So he earned the profits from price differences. So it is a risk-free profit. So buying cheap in one market, selling in another market. Okay, he buys in Hyderabad and he sells in Chennai uh, market. Okay, so like this, that is a arbitrator. Then market maker. So he provides the liquidity. He gives the cash and he manages the spread risk. Then broke quoting buy or selling. Okay, he quotes the buy or selling price because he liquidate the thing. Then institutional investor. Okay, it is a portfolio protection. Okay, hedge large positions, not small position. Is a large position. So they place in mutual fund. Okay, hedging equity portfolio. So try to remember players, main objective, risk approach, simple example. Okay, so try to remember, don't get panic so that you will clear your exam. If you want to, you can take the screenshot of this and read it again and again. Okay, then trading, types of orders and settlement. Okay, so these are the types of orders. Okay, so market order, limit order, stop loss order. So methods are cash settlement, physical delivery, financial settlement. So the contract will be selected. Which type of contract? Okay. So you have to remember the contract, then orders, the orders matches, then trade will be confirmed, then the clear settlement. Okay. This is about the types of uh, trading. Okay, trading, order, settlement. Okay, types of order. Market order, so execute immediately at the current price. For example, Tata shares going up and down. Okay, but for example, in the morning 9:15, the price of the share is 220. So if you order at the market price, it may go 222, 225, or it may go to 220, 219, like that. So whatever the market order, then it is execute without our control. A limit order, that means, for example, the market is fluctuating, but you are going to specify particular price for that particular share. Okay, if you share mark in the uh, Tata Steel, you want to purchase only 220 rupees, quote 220, that will be order. Okay, the confirmed order. If it is not, then it will be cancelled. Stop loss order, trigger when prices hits at the setting level. So if the prices goes up to 15% above or below 15% or 10%, okay, the system itself, the broker itself is going to be uh, trigger that order. Okay, this is a stop loss order. They will save the uh, like investor while by stopping the loss. There is a stop loss order. Settlement method. So the settlement can be in cash. Okay, is a physical delivery. So actual assets may be delivered, where it is commodities or shares. Then financial settlement on expiry date of the contract. There is a final statement settlement, not financial statement. It is a final settlement. Okay, then we'll go to the clearing houses, market to mark, and span margin. Here there are three things we'll discuss: clearing house, market to market MTM, and span margin. What is clearing house? So it acts as a central counterparty between buyer and seller. Okay, so they eliminate the counterparty risk. If one party defaults, the clearing houses steps in. Then market to market MTM. So it is a daily profit. So profit or loss calculated and created or debited to your account every evening. Example, you buy Nifty futures at 22,000. It closes 21,900. So, 100 into lot size is debited from your account. So, this is a market to market. Then span margin. What is span margin? Standard portfolio analysis at risk. Standard portfolio analysis of risk, a system that calculates the minimum margin required based on overall risk of your portfolio. So what you have to remember, MTM, market to market. Okay. So it is a daily settlement, whether it is gain or loss, profit or loss. Span, it is a margin system used like NAC, BAC. Okay. These are the things. Okay. Then forward contract and concept, features and types. What is forward contract? It is a private agreement between the two parties to buy or sell asset at a future date at a predetermined price. So traded over the counter. OTC means over the counter, not an exchange. So what is private contract? It is a private agreement between the two parties, whether it is buy or sell an asset on future date at the predetermined price. So in the future date, what price they are going to buy or sell at the first they decide on which date, at what price they are going to buy or sell. So uh, like it is the traded over the counter, not on the exchange. So the what is the key features of forward market? It is fully customized. Quantity, date, price, at how much quantity you buy, at what date you are going to purchase, and at what price. It is fully customized. It's a long position. So buyers agree to buy, and short position, seller agrees to sell. But long position means buyers, okay, whereas short position means agrees to sell. Types of forward contract. It is a commodity forwards, wheat, gold, oil, silver, copper, etc. These are the commodity forwards. Means there it is a private agreement between two parties to buy or sell an asset in a future date at a pre-decided price. It is a over the counter, OTC. Okay. Currency forwards, whether it is US dollar, Indian currency, or European dollar. So interest forward. So they fix the future borrowing rate. Example, an importers agreed to buy US dollar at 84 rupees after 3 months. So this is the locking the exchange rate. I hope you understand the same. Listen again and again, take the screenshot. Okay, so that will be good enough. Then forward rate agreement, forward trading mechanism. What is FRA? It is a forward rate agreement. What is FRA? It is a forward rate agreement. Locks in a future rate, interest rate, settled in cash. No actual borrowing, lending happens through FRA. Okay. FRA means forward rate agreement. So it locks a future interest rate, settle in cash, no actual borrowing or lending happen. Okay. So borrower uses the FRA, future rate agreement, to protect against rising interest. And the lender, so uh, the person who gives uses a forward rate agreement to protect against falling interest. Okay, so a simple example, a company plan to borrow rupees 10 crores after 3 months. It enters FRA, forward rate agreement, today to fix the interest rate at 8%. Even if the rate rises by 10%, he pays only 8%. It is a forward rate agreement. So what you have to identify the asset which you want to buy, and you have to negotiate the quantity, how much quantity you want. Okay, and you have to negotiate the at what price you want to purchase or sell it, you have to set future date after 3 months, 2 months, and you have to enter the agreement. This is the forward agreement, forward trading mechanism. Okay, it seems to be critical, but with this particular class simplified every concept in a lucid manner. Okay, so forward versus future. Okay, what is the difference between forwards and futures? Futures. Okay, it is a feature, it is a forward contract, it is a future contract. So, what is the trading venue? Where it happens? Over the counter. The forward market happen over the counter privately. Whereas future contract happen through NSE, BSE exchange, Bombay Stock Exchange and National Stock Exchange. Then customized. So, it is fully customizable. Whereas future contract, it is a standardized by NSE BSE. So counterparty, the risk is very high as it is private. Whereas future contract, low is clearing houses center. So margin, no margin. Here margin is required. Daily, no, it is not daily. Yes, the future contract can be done daily. Liquidity, liquidity is very low. Okay, whereas futures, the contract liquidity is high. Settlement on maturity date only. Whereas futures, it happens daily plus final. Regulation, the forward market is unregulated because it is a private one. It is done over the counter. Whereas futures contract is regulated by Security Exchange Board of India. So try to remember forward mark forward contract is flexible and customized, whereas future contract is standardized, liquid and exchange trade. This is the thing. Then we'll see about the future contracts, concept, types, and evaluation. Here we'll discuss about the what is future contract, types of futures. Okay. So what is future contract? A standardized exchange traded agreement to buy or sell an asset at a fixed price in a future date. So both buyer and seller obligated to fulfill the contract. The clearing house agreed the guarantees the performance. So it requires a margin deposit every day. It's subject to daily market to market. So it is a standardized exchange traded, okay, which involves stock market. Okay, so the types of futures. Okay, so stock futures, index futures. So stock future is a share specific, Reliance, TCS, Infosys, whereas index future Nifty 50, Nifty, Sensex, etc. Whereas commodity futures, which involves gold, crude oil, silver, copper, etc. Whereas currency futures, which involves US dollars, Indian currencies, interest rate futures, so government bonds, securities, etc. Okay, these are the types of futures. Remember. Then players and functions trading mechanism in futures markets. Okay, who is the players in the futures? Okay, so hedgers who take the risk. Okay, transfer the risk. Exporter hedging US dollars and INR. Speculators profit from price movements. So they add the liquidity. Arbitrager. So they exploit the price gap, improve the market efficiency. Institutional investors. So foreign institutional investor, we can say that FIIs. Okay. DIIs. That is the domestic institutional investors. So mutual funds manage large portfolios. So remember this thing, who is the players. Okay, hedgers, speculators, arbitrager, then institutional investor. Try to remember their functions, their names. So how it is happen, the mechanism happen, they select the contract and they order the orders matches, then they deposit the margin, then position is created. Okay, this is the thing. Then specifications and pricing of the futures. So contract specifications, underlying assets. So maybe Nifty 50, gold, US dollars or Indian rupees. Contract size. It is a fixed lot size. Example 50 for Nifty. Whereas expiry date last Thursday of a month. Every last Thursday of a month. It is expiry date. Tick size. So minimum price movement. Settlement where it is cash or physical delivery. So important numerical problems area. So you have to remember the same. No income asset, this is the formula. Whereas known income, this is the formula. Okay, known dividend, this is the formula. So try to remember the same. Okay, then hedging with futures and forwards. What is hedging? It is a taking a position in derivatives to reduce the risk of an existing exposure. There are two types of hedgers. Okay, long hedge, short hedge. So long hedge means buying the futures to protect against the price. Example, importer. Short hedge means sell futures to protect against the price fall. Example, farmers. Okay, then the basis of risk. Basis, the spot price, okay, the seller price minus future price. So basis price, the risk, the basis changes uh, expectedly, so making the hedge imperfect. Whereas cross hedge, so hedging with a futures contract and a different but related assets. For example, you can say here the importers example. So they fears US dollar will rise versus Indian INR. Okay, like buys US dollars futures today, locks in exchange rate, protect from rupees weakening. Whereas farmer example, so fears wheat prices will fall and he sells the wheat's futures today, then locks the selling price, protected from the price to drop. This is the hedging with futures and forwards. Okay, so let us have one of the important things about the concepts, types, and basic principles of options. I'll read out. What is option? A contract giving the buyer the rights but not the obligation. So, to buy or sell an asset at a fixed price, that is a strike price, before an expiry date. So, the buyer buys at premium to the seller writer. So, easy remember, call option means right to buy, put option right to sell. So, let us see what is call option, what is put option, what is American option, what is European option. So, call option, right to buy a strike price, which is useful when the price expected to rise. Whereas put op, put option, so right to sell at a strike price, useful when you expect the prices to fall. American option, so can be exercised anytime before the expiry. European option can be exercised only on expiry date. That is the last Thursday of the month. So try to remember. Okay. Then options versus futures, base was like basic option positions, etc. etc. We'll see options versus futures. What is that? It is a feature, it is a options, it is a futures. Right. So options is for buyers, for futures no. obligation. It is only obligation to the seller, where in futures both buyer and sellers are obligation. Premium paid by the buyer, in future none. Buyer's max loss, so premium only, whereas unlimited happen. Seller's maximum loss, unlimited, unlimited here. So there are four basic positions of options. Okay, long call, so bullish view, so maximum loss equal to premium, then profit is unlimited. Short call, so it is a bearish falling market, is a neutral, maximum profit equal to premium, loss unequal, unlimited. Long put, so it is a bearish view, opposite of long call, so maximum loss premium, profit very large. Whereas short put, okay, it is opposite of short call. It is a bullish neutral, maximum profit equal to premium, whereas loss is large. Try to learn these four basic positions: long call, long put, short call, short put. Okay, then we'll discuss difference between option strategies, hedging, currency options. So this strategy, there is a plan, construction, market view, purpose. So covered call, it is a one stock plus sell call. Whereas market view is when is the market is neutral or mild bullish, which generate the income. Protective put. Okay, so own stock plus buy put. So bullish but very cautious. It is downside protection. Bull spread. So buy low strike call plus sell high strike call. Whereas market view, it is a moderate bullish. The purpose is in order to limit the price profit or loss. Bear spread. So buy high strike put, sell at low strike put. So market view is a moderate bearish, whereas limited profit or loss. Then straddle, it is a strategy, buy call plus buy put in the same strike, is a high volatility expected. Okay, whereas profit from big move. Straggle, buy call plus buy put, different strikes. It is very high volatile market, whereas clear than straddle. So these are the strategies we use in a market, especially for the options, hedging, currency options. So covered call, what you have to do in protective put, what you have to do spread bull, what is market view, how you have to do bear spread, how the market bearish and straddle, high volatility time straggle, it is very high volatility. So try to remember, okay, and it is not only useful for your exams, but also it is useful for your those who are interested in trading. So importers, so currency call, buy US dollar call at option, protect the US dollars rises versus INR. So exporter, currency put, okay, buys US dollar put option in order to protect if the US dollar falls versus Indian currency. Okay, so let us see valuation of options and binomial model. So factors determine the uh, option value. Current asset price, okay, equal like higher price, higher call value. Strike price, higher strike, lower call value. Time to expression, more time, more value. Volatile, higher volatile and higher option value. Risk free rate affects cost carry. Dividend reduce call value. So option value equal to intrinsic value plus time value. So intrinsic value is maximum strike value minus K uh, into for a call. So binomial formula model, it is very important. Risk neutral probability, you have this is the formula. Whereas option value, this is the formula. Okay, try to remember. Take the screenshot. Then Black-Scholes model, the Greeks. Okay, this is the call Black-Scholes formula. Try to remember this formula. Okay, and try to write something in exam. Put price, this is the formula. Okay, then this is the explanation. So the Greeks easy memory table, delta, what is measured? Changes in option price per rupees 1 change underlying. So remember underlying price. Gamma, it is a rate of change of delta, change in delta. Theta, it is shown with the uh, like theta, it is the option value lost price per day, whereas time decay. Vega, it is sensitive to volatile. Okay, it is volatility. Roho, it is the sensitivity to interest rate. So this is the thing you have to remember. Then Indian, it is a fifth unit. Indian derivatives market and final revision. So development of Indian derivatives market. So which is done by LC Gupta committee, which is recommended frameworks for derivatives, focus on investor protection and risk management. So what is done? LC Gupta, the committee is there which recommended how to do the derivatives. So in our, because this derivative market is very fluctual and which makes the people lose the money. So in order to protect their money, in order to have the risk management, so LC Gupta uh, committee recommended about the frameworks of derivatives. Then JR Verma committee. So they designed risk containment and margin methodology and exposure control. Then NSE BAC. So and National Stock Exchange on uh, Bombay Stock Exchange. So electronic order matching, span margin, SEBI regulated eligibility stocks. So what you have to remember, what is derivative? It is a financial contract whose value is derived from underlying asset. Underlying asset we discussed. What is MTM? So market to market, daily adjustment, profit and loss in future account. Forward versus future. Forward are over the counter customized, whereas futures are standardized and exchange rated. What is call option? Is the right, not obligation, to buy assets at the strike price. What is delta measure? So it changes option price every rupee change underlying assets. So repeat this particular video again and again. If you really like my channel, please do subscribe and share with your friends. All the best for your exams. At least try to watch this video, okay, 10 to 15 times so that your success rate will be high. Thank you.